Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And JP Morgan says the last rate hike is coming in September, but with the global economy already headed into recession, the Fed is about to make things much worse. Let's head over to Bloomberg, where we picked today's story up as JP Morgan strategists see last big Fed rate hike in September as a growth policy trade-off to improve the second half. But shockingly, they expect growth stocks to outperform. Well, we'll see about that. We expect another outsized Fed rate hike in September, but post that, we would look for the Fed not to surprise the markets on the hawkish side again. They expect the trade-off between growth and monetary policy to improve from here on and, quote, help the overall market to keep recovering, but that seems unlikely because when we look at the federal funds rate, here we have in blue against the NASDAQ 100, we're going to use that, our proxy for growth stocks. What you find out is that when the peak is usually in and the Fed starts to pause is not a good sign. It usually means the Fed is pausing because bad things are coming and you see stocks head lower. There are times the stocks can continue to grind higher, but ultimately when the Fed is pausing, that means bad things are coming. The only time it didn't play out that way, we headed into a pandemic when we had massive amounts of fiscal and monetary stimulus, but here we can see already it appears the top is in, and with the Fed continuing to hike, it just means more chaos to the markets is coming. And those at Goldman Sachs agree that the path of inflation and growth will drive the trajectory of stocks in the second half, but they see limited room for gains after U.S. stocks enjoyed one of their best summer rallies on record. Renewed fears about the prospect of a recession would almost surely unwind the recent rally, and while there's some truth to about how we will likely see another recession, because not only does a big rise in the consumer price index indicate that the probabilities of recession are high, we actually see that tech stocks do very poorly during periods of high inflation that roll over into disinflation or even deflation. Here on this chart, we have the consumer price index in blue shown on a year-over-year rate change against, again, the NASDAQ 100. And notably, you see inflation peaking here and coming down, which you'll hear is, man, that's great for stocks. But, well, it wasn't great for stocks in the dot-com bubble. And how about the great financial crisis, where you can see consumer prices rallied up, peaked, came crashing down? Well, it came crashing down with stocks as well. Here you can see consumer prices kind of outside of 2018 into 2019, peaking, starting to roll over, and that put the slowdown on stocks. You see it happening here again in 2015, and now we're about to see that one more time. And we suggest investors use a rally in tech to reduce positioning in excess of recommended benchmarks and to lighten portfolio exposure to high beta names, rebalancing funds to our preferred areas of the market like value and quality income, or in a sense, take some of the risk off is just a much easier way to say it, because what is likely to come, as you just saw, is more downside risk to equities here, and investors would be wise to put some hedges on. It's foolish, though, to fight the dollar dominance, because this is really a story about the dollar and not so much the Fed, as the rally in the dollar picks up speed as we see a surge in U.S. currency has sent global peers tumbling this week. And I want you to understand as we get into this dollar story here that when you see a strengthening dollar, particularly as the dollar is a global reserve currency, it means there's a dollar shortage. That is not very good for sustainable inflation, but it's bad news for the global economies. It's bad news for stock markets. And you're about to see that here shortly. It's the easiest trade in currency, according to Twindale, a 25-year markets veteran and Asia-Pacific chief executive broker at FP Markets. He says until there's a dramatic shift in fundamentals and rhetoric with the Fed, because it's all about the Fed, you'd definitely be foolish to sell a dollar when the whole world is so nervous or really just short dollars. And here you can see the federal funds rate in blue against the nominal broad dollar index. And here's the belief that, of course, that the Fed truly controls the dollar. Well, it's more along the lines as the market controls the dollar, but the belief is as long as the Fed is continuing to hike, the dollar will continue to gain strength. And now how does that translate into tech? You say, well, maybe that's bullish for tech. Well, not so much. Here you can see now the dollar broad index in blue overlaid against the NASDAQ 100 in red. And what do you see? The dollar surging higher. What is it telling you? There's a liquidity crisis. There's a dollar shortage, and that's bad for stocks. And you see, look what happened going into 2015, where the market flattened out we almost had a recession. The dollar went on a ripping tear higher. How about here in about late 2018 and 2019? The dollar goes higher, tech comes down. Dollar shoots higher during the pandemic, tech comes crashing down. Here you see the dollar continuing to move higher, looking to break out, and that means another tech wreck is more likely to happen than anything because the dollar shortage isn't getting any better. Now, if you're concerned at all what another dot-com bust could mean to your portfolio, I'll put a link up here to Portfolio Shield in the corner and description below, because not only is the dollar likely to head higher, but many people are championing the Fed to keep tightening. As here we see Summers urges the Fed to deliver stark message on economic pain as the former Treasury chief speaks on fears and hopes for Jackson Hole, and he says easing in financial conditions must be a worry. Now, what is he talking about when he says easing in financial conditions? What he's referring to is the fact that despite the Fed tightening here, the stock market is rallying, and that means, of course, financial conditions are easing, and the market is not fully pricing in the Fed in terms of how serious they're going to be. And he's saying the Fed needs to get serious here. The reality is that it's probably not so realistic to think the Fed will get inflation all the way down without unemployment up, a case I have made numerous times on this show, and they don't want to acknowledge that. That forces a certain confusion into all of their statements, and it is true. And here's just some of the areas I've highlighted. We have the consumer price index in blue on a year-over-year rate of change against the 4-week moving average of initial claims in red, and notably, when claims go higher, inflation comes down. You see it here. Claims higher, inflation down, claims higher, inflation down, claims starting to bottom out and turn higher, inflation coming down, and now claims are starting to head higher, and it's all just an indication of what we say on the show, is that when people lose their jobs, their income goes down, but their bills don't, particularly in times of high inflation and high debt loads. They have to service that, so where do they stop doing? Spending money out in the real economy. Happens every time. That's where you get disinflation. That's how you can get outright deflation. And Summers is right. The Fed cannot balance the two. At Jackson Hole, he says, my hope is it will get clarity that policy is not yet restrictive, referring to the fact that the Fed needs to tighten more and that it needs to be restrictive if we're going to contain inflation, and that we'll need to accept the consequences of that, meaning we're probably going to have a recession. He added that he hoped that the message will be delivered starkly and clearly. And all this is translated into the fact that we're already seeing the global economy heading into recession. We have some data today that validates and proves it. So when you think about what the Fed is going to do in September, there's two things that are going to happen. One, they're likely to raise rates again. And as I've suggested on Twitter recently, look for a pause ahead from the midterms elections in November. And then the other factor here, maybe the X factor, is they're going to double the size of quantitative tightening starting with September. So let's check this out, because you're going to see the global economy is already headed into recession, and it's not going to get any better. Shrinking output from Europe to Asia feeds global recession fear as Eurozone activity falls for the second month on the inflation squeeze. Japan, Australia also record contractions as services suffer. Keep in mind, this is a story now about services sector. What did we hear? What have we been hearing from policymakers? Hey, don't worry, the manufacturing boom is going to slow down because everyone's going to start spending money on services. So it's okay that the manufacturing sector slows a bit. Watch services, they're going to boom. Yeah, well, watch services, they're not booming. They're contracting. Now, when we look at these preliminary, you see this P here, these preliminary purchasing managers indices. This is for Australia. A 50 is unchanged. Over 50 means an expansion. The greater the number over 50, the bigger the expansion. Under 50 means it's a contraction, and the smaller number under there is, of course, the bigger the contraction. I want you to think of this as a pendulum, and when the pendulum swings out and reaches a peak there, and that's 50, and if it starts swinging back down, that's where you get into those 40s and lower. And I want you to see that the global economy is peaking out here. Look at Australia, manufacturing at 55. How about the services? Peaking out at 50. Look at Japan. Manufacturing sector almost at stall speed. Services almost is at stall speed, both sitting just one above and one below 50. How about we go over to France? Look at their manufacturing sector, 49. How about their services, 51, stall speed. How about the German economy, the big juggernaut of the manufacturing sector in the Eurozone? Look at their manufacturing PMI, 49.8, stall speed. Services sector starting to contract at 40. 48. How about the broad Eurozone manufacturing stall speed of 49.7? How about their services sector, 50.2? Stall speed, Great Britain, manufacturing, almost at a contraction. You get to 45, you're at a recession, it's at 46. How about the services? Just slightly expanding to 52.5. But you're saying, Steve, it doesn't matter what's going on in the rest of the world. The U.S. is an island. We're going to boom. Didn't you know that? Well, we got the U.S. preliminary data too. It says U.S. business activity contracts again, the weakest since May of 2020, as a global composite measure falls to 2.7 points to wait, 45 in August, a contraction? Well, check this out. The preliminary manufacturing PMI, 51.3, just a mid slight expansion. Look at the services, 44, tells us the services sector is in a recession, with the U.S. global composite PMI at 45, signaling indeed we are headed into a recession here, and we're going to be facing perhaps a currency crisis as the dollar screams higher, because look at this, is China's yuan slides to a 2-year low as the economy stumbles and dollar soars. Now, are we going to see a devaluation of Chinese currency? Well, let's head over to our chief strategist, Jeff Snyder, who talks about in his daily that China's currency, the clock is running out. And he says over the past week, China's currency has renewed its decline against the U.S. dollar, referring to the yuan. He notes that this is an unwelcome reappearance of what for years I've labeled as the yuan's ticking clock. Its reappearance is unwelcome because we can and have repeatedly inferred what this must imply about euro-dollar issues and not strictly those relating to the Chinese currency and financial economy. In other words, he says authorities in China usually only resort to the contingent liabilities which set the clock ticking in the most serious euro-dollar deflationary instances. If you're not sure what he means by that, what he's saying is a weaker Chinese currency, a stronger dollar is highly deflationary. He's not suggesting they devalue. I'm suggesting that's coming soon, and all of it's telling us is something in the global economy is on the verge of breaking, and that's why, my friends, chaos is coming. Want to know more about what Jeff has to say on the economy? Click the link in the description below. Markets Insider Pro, free for a limited time. Get us daily, get smarter. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.